For years, Canadians have worn a badge of smugness, a quiet pride that while the world burned in 2008, our banks stood like fortresses of granite against the storm. We watched the subprime meltdown in the United States from the safety of our GICs and stable housing prices, convinced that our conservative lending practices made us immune to the contagion of greed. But there is a shadow fact that no one in Ottawa wants to discuss. Canada didn't actually dodge the 2008 bullet, we just caught it in slow motion. While the US deleveraged and purged its toxic debt, Canada doubled down, fueling an era of cheap credit that has now ballooned into the largest housing bubble in G7 history. Today, the visceral pain of the middle class is no longer a whisper. It's a scream at the grocery checkout and a panic attack at the mailbox when the mortgage renewal notice arrives. We are living in a house of cards built on the illusion of stability, and the wind is starting to pick up. As you sit there wondering why your 40-hour workweek barely covers the basics, you have to ask, was our stability just a 16-year delay of the inevitable? The answer lies in a hidden metric that the Big Five banks are desperate to keep off your radar, and it's about to change everything you thought you knew about your net worth. To understand the present, we must look at the ghost of 2008. Back then, the US faced a violent correction. Homes were foreclosed and the system reset. In Canada, we lowered rates and kept the party going. This created a generation of Canadians who believe that real estate is a one-way bet, a guaranteed ladder to the upper class. But the rungs of that ladder are rotting. The emotional toll of getting ahead has been replaced by the exhaustion of staying afloat. We see it in the eyes of parents at the park, calculating the cost of a Loblaws grocery run in their heads while their kids play. The cost of living has transcended mere inflation. It has become a systemic erasure of the middle class. We are working harder than our parents ever did, yet we are the first generation in Canadian history to be objectively poorer than the one before us. The Bank of Canada's interest rate hikes weren't just a policy tool, they were a sledgehammer to the foundations of the Canadian dream. Every quarter-point increase is a direct withdrawal from your future, a tax on your survival. And yet, the most dangerous part isn't the rates themselves, it's the shadow debt that isn't being reported on the evening news. Do you know where your bank is actually hiding its losses? Because the 2008 ghost is no longer haunting the US, it has moved into your basement.
The debt trap in Canada is not just a financial metric, it is a psychological prison. Currently, Canadians owe roughly $1.80 for every dollar of disposable income they earn, a ratio that would make a 2007 Lehman Brothers executive blush. This isn't just numbers on a screen, it's the visceral weight of a HELOC that was supposed to be a safety net but has become a noose. We've used our homes as ATMs for a decade, financing SUVs and kitchen renovations with the equity of a bubble, and now the bill is due. The Bank of Canada is trapped in a paradox. Lower rates and inflation destroys the currency. Raise them and the housing market collapses. Meanwhile, the average worker in the GTA or GVA is seeing 50 to 60% of their take-home pay vanish into rent or mortgage interest alone. The CRA's tax bite feels more like a feast as they take their cut of your inflation-adjusted salary, leaving you with pennies for your TFSA or RRSP. We've been told to save, to invest, to be prudent, but how can you build a future when the present is a constant state of emergency? The curiosity gap here is terrifying. If the middle class is the engine of the economy, what happens when the engine runs out of oil? The upcoming mortgage cliff is the moment of impact, and most Canadians are driving toward it with their eyes closed.
Let's talk about the housing bubble, the elephant in the room that has grown so large it's crushing the walls. In cities like Toronto and Vancouver, the price-to-income ratio has detached from reality so completely that it resembles a speculative cryptocurrency rather than shelter. This isn't just about supply and demand. It's about a financialized market where homes are treated as offshore bank accounts. The emotional pain is felt most by the young, the 20-somethings who did everything right, got the degree, got the job, yet find themselves living in a 400-square-foot condo that costs 3/4 of their salary. The dream of a backyard and a semi-detached in the suburbs has become a luxury reserved for the inheritance class. This creates a deep societal resentment, a feeling that the social contract in Canada has been torn up without our consent. We are witnessing the birth of a neo-feudalism, where your quality of life is determined not by your work ethic, but by when you entered the real estate market. But here is the open loop. Bubbles don't just stay inflated forever.
History shows us that the higher the peak, the more violent the trough. When the secondary lenders, the ones outside the Big Five, start to see defaults, the contagion will move faster than the 2008 crash ever did. Are you prepared for the day the value of your home drops by 30% while your debt stays exactly the same?
The Bank of Canada's interest rate cycle has created what experts call payment shock. For over a decade, we were addicted to 1% or 2% rates. But as those 5-year fixed terms expire, Canadians are facing a reality where their monthly payments are jumping by $1,000, $2,000, or even $3,000. This isn't just tightening the belt. This is a structural failure of the household budget. When you lose $2,000 a month in discretionary income, you stop going to local businesses, you stop car, and you stop contributing to the economy. This is how a recession turns into a depression. The visceral feeling of never getting ahead is now a mathematical certainty for many. We see the struggle in the skyrocketing use of food banks in affluent suburbs, places where poverty was once invisible. The relatable Canadian experience has shifted from hockey games and Tim Hortons to comparing the price of butter across 3 different grocery apps. The CRA doesn't care if your mortgage doubled. They still want their pound of flesh. This leads to a dangerous mistake many make: raiding their RRSPs to pay down debt, destroying their compound interest and their retirement security in one desperate move. But there is an even darker truth lurking in the commercial real estate sector. If the towers in downtown Toronto are half empty, who do you think is holding the bag for those multi-billion-dollar losses?
The Loblaws effect is more than just a meme. It is the most visible symptom of a dying middle class. When a single family controls the majority of your caloric intake and profit margins continue to swell while the average citizen struggles to buy protein, the social fabric begins to fray. It's the visceral anger of seeing a member price that still feels like a robbery. This greedflation, combined with stagnant wages, has created a pressure cooker. Canadians are working 40, 50, 60 hours a week, yet the CRA tax bite ensures that even a raise doesn't feel like a win. You move into a higher tax bracket, and suddenly your CCB payments drop or your GST rebates vanish. It's a treadmill designed to keep you in place. We are told that Canada is a land of opportunity, but for many, it has become a land of extraction. Every time you tap your card, someone else is getting rich while your balance dwindles. The curiosity gap here is, why is this happening now? Is it just bad luck, or is it a managed decline? The truth is that our economy has become a one-trick pony, and that trick is housing. When you stop building things and start just trading houses back and forth, you create a hollow economy, and hollow things break easily. The next scene will reveal the shadow banking secret that could be the pin that pops the entire Canadian bubble.
Behind the polished logos of RBC, TD, and Scotiabank lies a murky world known as the shadow banking system. These are the private lenders, the B lenders, and the unregulated credit unions that have taken on the risks the Big Five were too stable to touch. This is Canada's subprime market. When the BOC raised rates, these lenders were the first to feel the squeeze. They don't have the same capital cushions as the major banks. If they fail, the ripple effect will hit the main street faster than a forest fire. Many Canadians, unable to qualify at traditional banks due to the stress test, turn to these private lenders with 10% or 12% interest rates just to keep their piece of the Canadian dream. Now, those dreams are turning into nightmares. The emotional pain of knowing you are one missed payment away from losing your home is a chronic stress that is destroying the mental health of our nation. We talk about the 2008 crash as a historical event, but for a private lending borrower in Brampton or Surrey, the crash is happening this afternoon. The shadow fact is that the Big Five are more interconnected with these B lenders than they admit. If the bottom falls out of the private market, the granite fortresses of our major banks might find they are built on sand. How much exposure does your bank actually have to these high-risk loans? They won't tell you, but the balance sheets are starting to leak. The immigration and housing paradox is perhaps the most heated topic in Canada today, and for good reason. We are bringing in record numbers of new Canadians to support our aging workforce, but we have nowhere to put them. This isn't a relatable problem, it's a mathematical impossibility. When supply is stagnant and demand is artificially inflated, prices only go one way, until they don't.
The visceral reality is that both newcomers and multi-generational Canadians are being squeezed into basement suites and shared rooms that cost more than a mortgage did 10 years ago. The middle class is disappearing because the entry level has been obliterated. This creates a rent trap where it is impossible to save for a down payment because the rent is so high, and you can't stop paying rent because you'll be homeless. It is a closed loop of poverty. The CRA tax bite on top of this makes the TFSA RSSP advice feel like a cruel joke. How can you contribute $7,000 a year to a TFSA when you're choosing between rent and quality groceries? We are told to invest in Canada, but the smartest money has been leaving the country for years, seeking better returns in the US or elsewhere. If the people who live here don't want to invest in their own country, why should anyone else? This leads to the ultimate curiosity gap. If the housing market is the only thing keeping the Canadian GDP positive, what happens when the buyers run out of money?
Working 40-plus hours in Canada used to mean a life of dignity, a modest home, a yearly vacation, and a comfortable retirement. Today, that same 40 hours often means living paycheck to paycheck, terrified of an unexpected car repair or a dental bill. The disappearing middle class is not just an economic trend, it is a loss of national identity. We are becoming a country of haves and have-nots, with the have-nots including doctors, engineers, and teachers who can't afford to live in the cities they serve. This is the visceral feeling of never getting ahead, the sense that no matter how hard you run, the finish line is being moved further away. The CRA's relentless pursuit of every cent, combined with the BOC's destruction of purchasing power, has left the Canadian worker exhausted. Relatable life now involves staycations and side hustles just to afford the same quality of life our parents had on a single income. This is the emotional pain of the 2024 Canadian experience. We are told the economy is resilient, but that resilience is being built on the backs of people who are at their breaking point. What happens when the middle class finally breaks? History shows us that when the majority of a population feels they have no stake in the future, the system doesn't just bend, it snaps. Is Canada approaching its Lehman moment? The CRA tax bite is a unique Canadian agony. While our neighbors to the south enjoy lower taxes and higher wages, we are told that our high taxes are the price we pay for a civilized society. But as healthcare wait times explode and infrastructure crumbles, many are asking where that money is actually going. When you combine federal and provincial taxes with GST, PST, carbon taxes, and property taxes, the average Canadian is working until mid-June just to pay the government. This leaves very little for the discretionary spending that drives a healthy economy. The emotional pain of seeing your hard-earned money vanish before it even hits your bank account is compounded by the fact that the cost of everything else is skyrocketing. This is why the TFSA RRSP mistake is so common. People either don't have the money to contribute, or they use these accounts as emergency funds, triggering massive tax penalties and losing their contribution room forever. We are being taxed into a corner. The curiosity gap here is how much more can the Canadian taxpayer give before they simply stop trying? We are seeing a brain drain of our best and brightest to the US, where the dream is still alive. If Canada loses its talent and its capital, what is left? The answer is a debt-laden shell of a nation, waiting for the first domino to fall. And that domino might be the too big to fail delusion. The too big to fail delusion is the belief that the Canadian government will always step in to save the banks and the housing market. But there is a limit to the BOC's balance sheet. In 2008, the US government bailed out the banks, but the people suffered. In Canada, we think we can avoid the suffering through endless money printing and government intervention. But this intervention is exactly what is causing the visceral pain of inflation. You can't print your way to prosperity. You can only print your way to a devalued currency. Every time the government helps first-time homebuyers with new grants or longer amortization periods, they are simply throwing gasoline on the housing fire. It's a short-term fix that creates a long-term catastrophe. The relatable reality is that your increased home equity is a mirage if you can't afford to buy another house in the same market. You are house poor, rich on paper but struggling to buy milk. This is the ultimate curiosity gap. What happens when the government can no longer afford to bail out the system?
With our national debt to GDP ratio climbing, we are losing our safe haven status. If the world stops lending to Canada, the 2008 crash will look like a minor market correction compared to what's coming. The shadow fact is that the government is already preparing for a bail-in scenario. Do you know what that means for your savings?
A bail-in is a terrifying concept that most Canadians have never heard of. Unlike a bail-out, where the government uses taxpayer money to save a bank, a bail-in allows the bank to use its depositors' money to stay solvent. Yes, you heard that right. The money you have in your checking or savings account could be converted into bank equity, meaningless shares in a failing institution, to keep the bank from going under. This is the ultimate betrayal of the Canadian middle class. We were told our money was safe. We were told our banks were different, but the legislation is already on the books. This is the curiosity gap that should keep you up at night. The visceral fear of losing your life savings in an afternoon is no longer the stuff of conspiracy theories. It is a legal reality in the new Canada. This is why understanding where you hold your assets is more important than ever. Is your money in a Big Five bank, or is it in a credit union? Is it in CAD, or is it diversified? The emotional pain of financial ruin is a deep, dark hole, and the Canadian government has already built the ladder for the banks to climb out, using your money as the rungs. As we move into the final scenes, we will look at the black swan events that could trigger this sequence, and what you can do to protect yourself before the mortgage cliff becomes a mortgage abyss.
The black swan of the Canadian economy might not be a single event, but a convergence of failures. Imagine a scenario where the US enters a deep recession, our commodity prices collapse, and a major B lender defaults, all in the same quarter. This is the nightmare scenario that the BOC is trying to navigate. The visceral feeling of never getting ahead would suddenly turn into a visceral feeling of losing everything. For the middle class, the margin for error is gone. Most families are 2 paychecks away from insolvency. This is the relatable life of the working poor, a class that now includes professionals with 6-figure salaries. The GTA rent prices and Loblaws receipts have consumed the safety net. When the black swan arrives, there will be no cushion to absorb the blow. We have spent our rainy day fund on a decade-long party of low rates and high debt. Now the clouds are gathering, and we don't even have an umbrella. The curiosity gap here is, who survives? In 2008, it was the people with cash and no debt. In 2024, it will be the same. But in a country where debt is a way of life, how many people actually have cash? The answer is fewer than you think. The shadow fact is that even the wealthy in Canada are often just highly leveraged. When the tide goes out, we will see who has been swimming naked.
Let's dive into the commercial real estate ghost town. While everyone is focused on residential housing, the office towers in our major cities are facing a crisis of their own. Remote work wasn't just a pandemic trend, it was a structural shift. This has left billions of dollars in commercial mortgages at risk. These mortgages are held by pension funds, insurance companies, and our stable banks. If these towers lose their value, your RRSP or your pension might be the one taking the hit. This is the hidden connection between the empty office in downtown Toronto and your retirement in 20 years. The emotional pain of seeing your safe pension plan lose value because of a change in office culture is a visceral reminder that everything is connected. We are living in an era of the great devaluation. Whether it's the value of your dollar, the value of your home, or the value of your labor, everything is being eroded. The relatable struggle of the Canadian worker is that they are running a race where the track is made of quicksand. The CRA tax bite only makes it harder to pull your feet out. This leads us to the soft landing lie. The government wants you to believe they can fix this without a crash, but can you really land a plane that has no engines and is out of fuel?
The soft landing is the favorite phrase of central bankers who want to avoid a panic. They tell us that inflation will come down, rates will stabilize, and the housing market will simply cool off rather than crash. But history is not on their side. In the history of the Bank of Canada, how many times have they successfully hiked rates this fast without causing a recession? The answer is almost never. The visceral reality is that a soft landing for the economy often feels like a hard crash for the individual. If you lose your job, it doesn't matter if the GDP only dropped by 1%. For you, the recession is 100%.
The emotional toll of job insecurity in a high-cost country like Canada is devastating. We see it in the rising rates of anxiety and depression among young workers. They are doing everything right, but getting nowhere. The curiosity gap is, what if the soft landing is actually just the first stage of a multi-year decline? What if Canada becomes the lost decade Japan of the 21st century? Stagnant growth, high debt, and a declining population of young people who can afford to have families. This is the future no one is voting for, but it's the one we are currently building. In the next scene, we will look at the US versus Canada comparison. Why our neighbors are recovering while we are stalling. Why did the US recover from 2008 while Canada is just now entering its crisis? The reason is simple and painful. The US took their medicine. They allowed the crash to happen, purged the bad debt, and rebuilt on a more solid foundation. Canada, meanwhile, used a sugar high of low rates to pretend the problem didn't exist. Now the US has higher productivity, higher wages, and a more diversified economy. Canada has houses. We have become a nation that trades real estate instead of innovating. The visceral pain of this realization is that our safe path was actually the more dangerous one. We are now more vulnerable than the US was in 2008 because we have no plan B. Our oil and gas sector is under regulatory pressure, our manufacturing is struggling, and our tech sector is being drained by Silicon Valley. The relatable life of a Canadian is seeing your American counterparts earn 30% more for the same job while paying 30% less for their mortgage. This is the brain drain in action. The curiosity gap here is, can we pivot? Can Canada rediscover its productive roots before the housing bubble pops? Or are we destined to be a cautionary tale for the rest of the world? The shadow fact is that the smart money is already moving across the border. Are you the last one left at the party?
The TFSA and RRSP mistake is perhaps the most tragic part of the Canadian financial struggle. We are taught that these are the keys to wealth, but in a high inflation, high debt environment, they can become traps. Many Canadians are so desperate to pay down their high interest debt that they stop contributing to their retirement entirely. Others make the mistake of investing their TFSA in safe GICs that don't even keep up with the real rate of inflation, effectively losing money every year. The visceral feeling of doing the right thing and still losing ground is a uniquely Canadian pain. The CRA tax bite on RRSP withdrawals is another trap. People in financial distress pull money out only to be hit with a 30% withholding tax and a massive bill at the end of the year. It's a system that punishes the desperate. The relatable struggle is trying to understand complex tax codes while you're worried about how to afford your kids' hockey equipment. We are being outmaneuvered by a system that was designed for a different era. The curiosity gap is, how do you actually win in this environment? Is there a way to protect your wealth that doesn't involve the Big Five? The answer involves looking outside the traditional Canadian investing box, but it requires a level of risk that most are too terrified to take. But as the 2008 ghost returns, is playing it safe actually the riskiest move of all? The mental health toll of the Canadian financial crisis is the silent epidemic. We talk about interest rates and GDP, but we don't talk about the marriages ending over money, the parents who can't sleep, or the young people who have given up on ever having a family. The visceral pain of financial stress is a physical weight, a tightness in the chest that doesn't go away. This is the reality of the disappearing middle class. When you lose your sense of a secure future, you lose your sense of purpose. The relatable life in Canada has become one of faking it. We drive the nice cars and live in the nice houses, but behind closed doors, we are drowning in credit card debt and HELOC interest. This culture of debt is a poison. The curiosity gap is, how long can a society function when its citizens are in a constant state of low-level panic? We are seeing the results in our healthcare system, our crime rates, and our political polarization. People are angry, and they are looking for someone to blame. Whether it's the BOC, the CRA, or the grocery CEOs, the anger is a symptom of a deeper wound. The Canadian dream wasn't just about a house, it was about peace of mind. And that peace of mind has been sold to the highest bidder. What happens when the anger turns into action? The final scenes will look at the survival strategies for what's coming next.
The black swan event that could finally trigger the crash might be something as simple as a change in sentiment. Markets are driven by psychology as much as math. If Canadians suddenly stop believing that housing only goes up, the FOMO, fear of missing out, will turn into FONGO, fear of not getting out. Once the selling starts, the lack of liquidity in the Canadian market will become a death spiral. Unlike stocks, you can't sell a house in seconds. It takes months. And if everyone tries to sell at once, prices don't just dip, they crater. The visceral fear of being stuck in a depreciating asset with a massive mortgage is the ultimate nightmare. This is the curiosity gap. If your neighbor sells for 20% less than you thought their house was worth, what does that do to your net worth? For most Canadians, their home is 90% of their wealth. A 20% drop in housing is an 18% drop in their total life's work. The CRA won't give you a tax break on that loss, and the BOC won't bail you out. This is the mortgage abyss. The relatable reality is that we are all interconnected. If the housing market fails, the construction jobs disappear, the real estate commissions vanish, and the consumer spending that keeps the lights on at the local mall dries up. We are one sentiment shift away from a completely different Canada. Are you holding the bag, or are you ready to move?
What does a survival strategy look like in a country on the edge of a 2008-style crash? First, it requires a brutal honesty about your own situation. Are you overleveraged? Is your wealth just debt in a different wrapper? The emotional pain of downsizing or selling an investment property now might be the only way to avoid total ruin later. This is the relatable Canadian crossroads. Do you keep trying to keep up with the Joneses, or do you realize the Joneses are bankrupt? The CRA tax bite and the BOC rates are out of your control, but your debt level is not. We are entering an era where cash is king again. In 2008, the people who survived were the ones with liquidity. They were the ones who could buy when everyone else was forced to sell. The curiosity gap here is, where do you put your cash when the banks are at risk of a bail-in? This is where diversification becomes a survival skill. Gold, silver, US dollars, and even certain international assets are becoming more attractive to the woke Canadian investor. The mistake is thinking that the way things were is the way things will be. The 2008 crash changed the world. The 2024 Canadian crash will change our nation forever. The question isn't whether it's coming, it's whether you'll be a victim or a survivor. The final warning is about to be issued.
The final warning for Canada is this: the stability we prize is our greatest weakness. Because we haven't had a major correction in decades, we have forgotten what risk looks like. We have built a society on the assumption of infinite growth in a finite world. The visceral pain of the disappearing middle class is just the beginning. The shadow fact that will eventually come to light is that our economy was a giant carry trade, borrowing cheap money to buy expensive assets. That trade is now over. The BOC cannot save us without destroying the dollar. The CRA cannot tax us into prosperity. The relatable life you once knew is being replaced by a harsher, more competitive reality. This is the emotional pain of a nation losing its way. But in every crisis, there is opportunity. The people who see the 2008 ghost for what it is, a warning, will be the ones who build the new Canada. This requires a shift in mindset, from consumption to production, and from debt to equity. It means prioritizing your TFSA and RRSP with assets that actually grow, not just debt-based products. It means being prepared for the mortgage cliff and having a plan for when the too-big-to-fail banks show their cracks. The curiosity gap ends here. The crash isn't a future event. It is a process that has already begun. Are you watching it happen, or are you taking action? As we look toward the next decade, the curiosity gap shifts from will it happen to how long will it last? Canada is a resilient nation, but resilience requires truth. The truth is that our middle class is being hollowed out by a combination of greed, bad policy, and an addiction to easy credit. The visceral struggle of the 40-hour worker is a signal that the system is out of balance. We must return to a Canada where hard work leads to progress, not just survival. This means demanding more from our institutions, protecting our own wealth, and refusing to be victims of a 2008 moment that we all saw coming. The ghost of 2008 is here to remind us that debt always has a due date. Whether you are in the GTA, the prairies, or the Maritimes, The payment shock is a universal Canadian experience. But remember, a crash is also a clearing. It clears out the rot, the excess, and the illusions. What remains is what is real. Your skills, your community, and your ability to adapt are your true net worth. The CRA can't tax your resilience, and the BOC can't devalue your integrity. As the house of cards trembles, look to the people next to you. In the end, that is the only safety net that has ever actually worked. The 2008 crash is here. It's time to wake up and face the dawn of a new,